And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Well, here we go. Once again, Luke Smith from Envision Financial. Good afternoon.
Good afternoon.
It's just the other day you were here.
Oh, feels like every other day is Friday at the moment.
Friday whips around so rapidly, I feel like I'm on a merry-go-round.
Let's just get to Christmas.
Well, yeah, before we get on to... yeah, well, that's rapidly approaching too, isn't it? Don't get me started.
100%.
Before we get on to our topic for today, we had a phone call earlier in the week from a listener who asked this question. What is the difference between a binding and a non-binding nomination in your superannuation? Now, I know we've spoken about this before, but maybe we should have a little recap.
Yeah, so the primary difference between a binding and non-binding nomination is with a binding nomination, the trustee of the super fund is obliged and directed to follow your instructions. It removes their discretion. So the issue that you have when you make a nomination, let's say I make a nomination to my wife and I say in the event that I die and she didn't cook the mushrooms, I give everything in the super fund to her and it's a binding nomination. It says to the trustee, pay it there. I don't care for your view. I don't care for your input. I don't care for your opinion. Pay it here. It is the most secure way to transfer money out of superannuation. Now, you can generally have a binding nomination to a spouse, minor children, and your estate. A non-binding nomination is where you give direction to the super fund trustee and say, hey, I'd like it to go over here, but I'll let you have some input in that decision.
Okay, why would you choose a non-binding option? I'm going to assume most people, when they want to nominate somebody, they're pretty firm about it.
Look, completely. And for me, my general rule and the solicitors that I have around me have always had the opinion that as part of your broader estate planning, certainty and control is the primary objective of that documentation. So you should control what you can control with the greatest certainty. And it's always binding, whether it's to a spouse, to the estate. And then what people need to keep in mind is that your will has no power over your super. So think about a binding nomination as like directing the money in super somewhere. And the important thing is that you want to consider as part of your broader estate planning, whether it's how your will's written, the transfer of assets, the use of testamentary trusts, which we've spoken about in previous shows. How can I get my money to the right entity for the right personal and tax planning reasons? Because you need to be careful, because as we've said in the past, taxable component of super is a 17% liability to non-dependent children. So you need to be careful where you've made your nomination, whether it's binding or not binding. If you've got money going to adult kids and you have a taxable component in your super, you're going to say goodbye to 17% of that balance. Now, that's a lot. So binding is greater certainty, removes the discretion of the trustee. Non-binding is, think of it more like a suggestion. If the super fund trustee was ever challenged from an external party, that's where I believe the non-binding situation becomes an issue, because someone could put a case forward to the trustee and go, oh, but Leon promised me $50,000 and here's all the proof, and cry, whinge, whinge, and try and get something. The trustee in that situation may go, okay, sure. Or, well, I'm not going to give you 50, I'll give you 20, go away. And the rightful beneficiary of the deceased's super balance goes, hang on, who are you and what are you doing here? So again, it just comes down to ultimate control, limited control, but they are very, very different in their structure.
And maybe have a chat with your financial advisor before making that decision.
Well, I think the big takeout here for people listening is that it should be part of your broader estate planning paperwork. I think people discount the power and the importance of a will, and people come in the office regularly and say, well, what are we going to do in relation to our estate issues? Oh, it's okay, I've got a will, it covers everything. Well, it doesn't. Or they'll say, well, I've got a binding nomination and I'm going to put it here. And there are things like testamentary trusts that are wonderful vehicles that when I explain the value and use of them to people in my office, 99.5% out of time they say, where can I go to get some advice? I need to learn more about this. That sounds like a wonderful vehicle that hasn't been explained to me already. So I think people need to have a much better understanding around the estate planning world and the vehicles available to them. And the binding nomination becomes an integral part of that, because you want to make sure that all the creeks run into the same river, because you can make some rather catastrophic, that's a rather strong word for a Friday, you can make some rather dangerous assumptions and decisions, because let's say you've gone to get really good estate planning advice from a solicitor, and you've got a newly drawn up will, you might have a blended family, you might have various entities that hold assets. In that will, you might have the creation of testamentary trusts for children, and your children may have children. And one of the big benefits of a testamentary trust is that you can pass income to minor children and get adult marginal tax rates. Now, that is hugely, hugely powerful, because if you think about my situation, right? So use me as an example. Something happens to my father passes and has a poorly written will, or has got limited advice, poorly written is probably a bad word, and leaves everything to me. If I use whatever I receive to generate income, that income gets added to whatever I earn personally. A testamentary trust is a vehicle that can hold the assets from my father, that could then allow me to say, oh, I've invested the money that I've received and I've got $100,000 of income, 20 grand of income, 50 grand of income. Oh, I've got an 8-year-old daughter. I can pass the income from that testamentary trust to my 8-year-old daughter, and my 8-year-old daughter, through the use of that vehicle, gets adult marginal tax rates. So you can see the tax control and tax planning achieved through a well-written will and the use of the right vehicles can be really powerful. Now, if my binding nomination says, well, I'll pay something straight to my daughter and potentially not to the estate that then uses a vehicle like a testamentary trust, you could accidentally circumvent the estate planning work done by somebody who's a specialist, thinking, oh, well, I'll just pay it to the kids. So the direction of the binding nomination is really, really important, because it controls the transfer of super assets. It also then directly controls the tax implications. So you may have a minor child. You would probably want to get some advice and say, well, if I don't have a spouse but I have a minor child, I'd want my minor child to be the beneficiary, because they receive that money on a tax-free basis. If I've got a 12-year-old, a 15-year-old, a 20-year-old and a 22-year-old, I'm probably not leaving it to the bigger kids because of that tax liability that I mentioned before. So it's really important that people widen their horizons. And I think estate planning lawyers and people in this space can add massive amounts of benefit and massive amounts of value by getting people to think that whilst the perception for me of a will is, oh, it's just this and it's just that and it goes there and it's not a big deal. When you start delving into some of these complexities, a well-written will is hugely, hugely powerful. And I say you can't be a client of mine without one. That's how much I think I have an obligation to address this. Anybody that walks into my office, and anybody that's been in my office this year would attest, we spend plenty of time talking about what's available to raise the awareness and the importance of looking in this space, because people come to me and say, I just want to make sure I'm not missing out on anything. And I totally get that. But part of that obligation that I believe I should provide is awareness of things outside of my space. Now, I'm not a lawyer, but I know plenty of them, and I refer tons of work to a number of them. And I say to the client, well, here's your super and here's this and here's that. And if I'm talking super, binding nomination is part of that conversation, because we have binding, non-binding. Where can it go? Why do I have it? What do I do here? What if I've got a blended family? That's my cue to go, hey, this, and this is available. Go and see this person, and let's get that tucked away as part of a broader strategic analysis of where you are. Because obviously I don't do that work, but I spend a lot of time sending people to specialists in that space, because I believe that is a really overlooked part of people's financial journey. And it all comes back to binding or non-binding, and where's it going to go?
Indeed. And you said before that people assume wrongly that their will covers everything, and of course it does not cover what's in your superannuation
Correct.
fund. But if you want your will to control that, that's a matter then where you go to your super fund, ask for that binding nomination to be directed to your estate, and then your will does cover it.
Exactly, and that's the power of this vehicle or this functionality, is that you are directing the money, and that could be the balance of your superannuation. That could also include insurance proceeds. You're then directing that money somewhere, but that someone could then either have good or bad tax implications depending on where it goes. And when I say to a lot of parents that walk into my office and go, well, who've you made as a nomination? They go, well, I love my kids, so I went a bit to my husband, a bit to my wife, vice versa, and then I gave some to the kids. And I had this yesterday on a Zoom call with some people in Melbourne. It was, oh, well, I've given a third and a third and a third. And I said, okay, so you want your kids to pay tax? No, they're my kids, they don't pay tax. Yeah, they do. And here's why. Because of the structure of your super fund.
So that's a really important point, isn't it? So if you use your binding nomination to direct your superannuation money to your adult children, they'll end up paying tax on that.
Well, kids will pay tax whether it's binding or not binding. If money comes out of superannuation and it is deemed a taxable component, so the money in your fund has come from a tax source, which is superannuation guarantee, salary sacrifice, and earnings in the fund, all super funds record the composition of taxable source and tax-free source. A tax-free source could be a non-concessional contribution that we've spoken about in the past, where you might put in $120,000 of your own money and you don't claim a tax deduction. So that's a tax-free component, whereas taxable is salary sacrifice, deductible contributions and earnings, and it's recorded on a percentage basis in the fund. So regardless of where it gets paid, it's very important to understand, yes, I love this person, yes, I want this control, but at what cost? Like we said a couple of weeks back with insurance. Oh, well, I've got a massive insurance policy through my super fund and the proceeds will end up going to my children. Well, your children are going to pay 32% on the proceeds of the insurance policy. Well, if you left it to your spouse, then they'd be tax-free. So the use of a binding nomination is really, really powerful, can also be very, very dangerous if you don't understand the broader complications. And this is where great estate planning work is vital for people.
And I thought it was such a simple question. Turns out it's actually not. And
it's a whole show.
It is. In fact, that's what it's become, because we're running short of time.
No, it's beautiful.
It's time to take our break, and we'll come back and obviously summarise what we've discussed today after the break. Luke Smith from Envision Financial is with me in the studio today, and we've been talking about the difference between a binding and a non-binding nomination in your superannuation, thanks to a question we received earlier in the week from a listener, Pat from Jerrabombera. So, Pat, thanks for the question. It's turned out to be a lot more detailed than I had thought it would be. But, Luke, I guess we need to summarise some of the important points for people to remember.
Yeah, so you need to think first about what you're trying to achieve with any form of nomination. And there's a lot to be said here for getting great advice, because there are a range of reasons where you may or may not use a binding. Again, I'm not saying that they are perfect. I'm not saying that they're the only way to do it. But is binding more secure than non-binding? Yes. But there will be plenty of lawyers listening that go, oh, but I wouldn't use one in this situation and that situation. And that is probably 100% correct. So you need to consider your situation and your objectives, especially where now in today's society, you're dealing with blended families, you're dealing with potentially 2 generations of kids. You know, I've got 32, 35 and 29, and I've got a 2-year-old and a 3-year-old. You know, there are some really complicated estate planning requirements there, where you then might be incorporating life insurance policies to create capital, to create an estate. You might have assets going here, there and everywhere, inside and outside of super. But the binding nomination is to remove the discretion of the trustee. Now, for me, the last place in the event of a death, and I've seen 2 or 3 instances this year where clients have been really broken by the way certain industry funds have treated them on the passing of a loved one. And what I've seen this calendar year, the last place I would have my money in the event that I died would be in an industry fund. Because I have an instant where I lost a client in February, and it took 10.5 months to get the money out with a binding nomination from 2 different industry funds who will remain nameless. So again, the assumption, it'll keep things simple, it'll make it easy. No, not necessarily. Does it secure the control and direction of money? Yes, very much so. We then need to think okay, if it's coming out, who's it coming out to? And where is it going to land? Do we have a binding nomination to the estate? Do I have a binding nomination to my spouse? The other thing to keep in mind is, and again, get legal advice, if it comes out and goes to an individual, doesn't form part of the estate, it's a lot harder to challenge.
That's an important consideration, isn't it?
Yeah. So again, this is where the family lawyers out there, if they spend a little bit more time explaining the importance of a will, testamentary trusts, and some of these considerations, I think some overlook the power of the document that they're giving to the client. Because I have a lot of people come in and go, I've got this will. You've got a testamentary trust? What's that? They didn't explain that. And I say to people, how do you go in and ask for something you don't understand? That's not on the individual, that's on the provider of the service. So I want people to be aware of the importance of this sort of stuff, because we're only talking about potentially your second biggest asset on this earth.
Yep.
Maybe outside of your family home, maybe bigger than your family home. So the power of a binding nomination and use of it as part of your broader estate planning is hugely important and hugely powerful, because it's directing your life's work in some situations to an area that you want to get the money to as a priority.
Indeed. All right, Luke, it's time to ask, where can listeners get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the Strategy Stacker, Luke Talks Money on iTunes and Spotify, and we've got Envision Financial Canberra on the YouTube, so you can go back and see the backlog of all of our shows. And there's an entire chapter on this in Smart Money Strategy, Your Ultimate Guide to Financial Planning, where we talk about wills, enduring powers of attorney, binding nominations, and the use of testamentary trusts.
All of these things and more in Smart Money Strategy. It's a fine book that'll fit neatly into a Christmas stocking.
Fits great into a stocking.
Indeed. Luke, thanks very much, and we'll catch you next week.
See you next week, mate.
Luke Smith from Envision Financial, and Luke will be back with us again next Friday afternoon around the same time, between 4:30 and 5, to answer another intriguing finance question.